Hi everyone, welcome back to Stock Scope. Netflix just reported strong earnings, but the stock is down in the pre-market. So the big question is, if the results were good, why the market is selling? In this video, we are going to break down Netflix Q4 earnings, compare them with what analysts were expecting, and explain why the market reactions look negative despite solid numbers. Let's take a closer look.
Stock Scope. First, the headline numbers. Netflix delivered a top and bottom line beat. Revenue came in at $12.05 billion, beating consensus estimates of $11.97 billion. Earnings per share landed at 56 cents, reflecting the recent 10-4-1 split, also beating expectations. Operating margin remains steady at 25%, strictly in line with guidance. Financially, the core business is executing perfectly. The scale here is becoming undeniable. Netflix has officially crossed the 325 million subscriber milestone, but more importantly, look at the engagement. In the second half of 2025 alone, users consumed 96 billion view hours, a 2% increase year. This surge was largely driven by the release of Squid Game Season 2 and the final season of Stranger Things. The audience is now approaching 1 billion people globally. Let's analyze the impact. 96 billion view hours isn't just popularity. It represents pricing power. High retention reduces churn, the silent killer of streaming. By locking audiences in with massive hits like Squid Game, Netflix drastically lowers its customer acquisition costs. They don't need to spend billions marketing to win you back because their content moat ensures you never left. This engagement is supported by a widening content moat. Retention is being anchored by massive IP franchises, but the expansion strategy has shifted to live events. We are seeing the integration of the NFL, WWE, and the World Baseball Classic directly into the platform. This is no longer just a repository for movies. It is becoming a replacement for the cable bundle. Let's talk monetization. The idea is no longer an experiment. It is a growth engine. In 2025, this segment generated over $1.5 billion in ad revenue, reflecting a 2.5x year-over-year growth. The unit economics are compelling. Added tier revenue per member is now higher than the standard planned revenue due to the high average revenue per member ARM. Looking ahead to 2026, management is forecasting a doubling of ad revenue again. This is critical because, as we will see in later slides, organic subscriber growth is maturing. The ad tier is the lever Netflix must pull to maintain double-digit revenue expansion without solely relying on price hikes. Pay attention to the 2026 forecast. Doubling ad revenue again. This shifts the model from service to media network. Crucially, ad tier revenue per unit now exceeds the standard plan. This margin expansion is vital. It proves Netflix can increase revenue per user even if subscriber growth slows in mature markets. This decoupling of revenue from user growth is a major bullish signal. Geographically, the revenue mix is healthy, but shows where the velocity is. USCA in US and Canada remains the heavyweight with $5.3 billion. However, the real story is the international growth drivers. We are seeing double-digit velocity in international markets, with Latin America growing 20% on an FX-neutral basis. This global diversification is a key hedge against U.S. market saturation. Here is where the bearish argument begins. If we look at the revenue growth percentage, the slope is bending downward. Growth peaked at 17.6% in Q4 25, but the forecast for Q1 2026 drops sharply to 15.3%. The hypergrowth phase is decelerating, and this slowing momentum is exactly what forced the company to make a drastic strategic move. This chart presents the primary bear case. Dropping from 17.6% growth to a forecasted 15.3% shows a clear deceleration trend. The market hates slowing momentum. This downward slope suggests organic levers, like password sharing crackdowns, are maxed out. This creates immense pressure to find inorganic growth, perfectly setting the stage for the massive acquisition we are about to discuss. To combat slowing growth, Netflix has pulled the trigger on a massive acquisition. They are acquiring Warner Brothers. Discovery in an all-cash transaction valued at $27.75 per share. The target assets include the legendary Warner Brothers studios, the HBO Max platform, and the HBO brand. The strategic rationale is clear. They want a deeper library and the premium IP of HBO to reduce churn. This effectively consolidates the two highest quality streaming libraries under one roof. However, the cost of this deal is the main source of anxiety for investors today. This graphic explains the risk. To fund this all-cash deal, Netflix has secured a $42.2 billion bridge facility. This is a massive injection of leverage onto the balance sheet. While the strategic fit is obvious, the risk factor is the significant leverage increase in a high-interest rate environment. This changes Netflix from a cash-rich tech company to a highly leveraged media conglomerate. Here's a reality check. A $42.2 billion bridge facility is enormous. We are trading a clean tech balance sheet for a debt-heavy media one. In a high-rate environment, servicing this debt will eat into earnings. The market fears this leverage limits flexibility. If a recession hits in 2026, this massive debt load could turn their greatest asset into a dangerous liability. The immediate casualty of this deal is shareholder returns. The capital allocation strategy has been reset. Share buybacks are officially paused, while they bought back $2.1 billion in Q4. Future buybacks are expected to be zero until the deal closes and leverage comes down. The priority is now 100% on reinvesting in the business and servicing that new debt. Why take this risk? This chart explains the why. Despite its dominance, Netflix only controls 9% of total US TV time. The acquisition of Warner Brothers targets the massive 40% block of linear TV. They are not trying to beat Disney Plus anymore. They are trying to swallow the entire legacy television ecosystem. So, why is the stock selling off? It comes down to three factors. First, growth deceleration guidance dropped from 16% to the 12 to 14% range. Second, the debt overhang, that $42.2 billion facility, scares conservative investors. And third, the halt in capital returns investors hate losing their buybacks. Looking at the 2026 outlook, the company is guiding for $51.7 billion in revenue and a strong 31.5% operating margin. They expect to generate approximately $11 billion in free cash flow. This liquidity is crucial because it will be used almost exclusively to service the debt and pay down the bridge facility. Finally, look at the $11 billion in free cash flow. Previously, this funded buyback. Now, with buybacks paused until the deal closes, capital is prioritized for liquidity and debt service. We are entering a deleveraging phase. The company is effectively shifting focus from returning cash to shareholders to servicing its new balance sheet. Holding this stock is a bet that Netflix can manage this leverage while maintaining growth. To conclude, here is the thesis for StockScope. The fundamentals are strong. $1 to be in quarterly revenue and 325 million subs. However, the market perception is weighed down by slowing growth and massive debt. We are witnessing a valuation reset. NFLX is transitioning from a hypergrowth stock to a mature media titan. The price action will likely remain volatile until the integration proves successful. Thanks for watching.